I keep coming back to what happens to the bond market because I feel like that's really the tail wagging the dog. And everyone's looking over here at the tariff headlines and moving around and reacting to every, first he goes with a big number and the market sells off, and then they make an agreement and it's half of the number that the headline suggested, and then the market rallies back. And in the meantime, in the background, the real existential threat to the economy, which is rates staying at this level, continues, and it doesn't seem to be getting that kind of attention. I did a chart just looking at the 10-year yield, and I laid on top the 3 and 4 year moving averages of the 10-year to see if we had ever had a period where rates, after coming down, went up and stayed this far above their 3 and 4 year averages for this length of time. And we've never stayed this length of time. When we've come close to it, you will not be surprised to learn a lot of very unpleasant things have happened. And that brings me back to something I wanted to chime in on when you were talking about the precipitating the recession and how that would unfold. And I guess my feeling is the slow train versus the fast train, it's still a train wreck, is that the way I see it sort of unfolding is that we continue to grind lower and lower on the consumer to the point that it creates a little bit of a credit panic where credit risk is repriced across the entire credit market. So not just in the consumer segment, much less in just the student loans, consumer segment, but eventually people start to say, oh, look, these people got sloppy with their underwriting standards on that one facet of consumer debt. Maybe they did it with all consumer debt. And if they did that with consumer debt, maybe corporate debt, and all of a sudden, what happened in 2008-9 is actually you had the economy, consumer was in recession in 2007. And it took a long time for the markets to begin to reprice the credit risk. Then you had the spectacular credit bust, which then exacerbated the existing recession and made it even worse. So you have first, the average consumers in recession, then the credit bust follows on that. And then you kill the high end because the credit bust crushes their net worth via both housing and all the risk asset stocks especially. And that causes a reverse wealth effect that makes the recession even deeper until, of course, they come running in with the fire hoses. I'm a huge fan of all of the real pro-business, pro-America, let's give Main Street a chance for once policy. I couldn't be more enthusiastic about that. But at the risk of being like a terrier on a pant leg with this, I feel like bond market is still the thing. It's the bugaboo that just won't go away. So you can do all those wonderful things, but you still have to deal with the problem that the average consumers are going to get no relief from the oppressive level of, 23% credit card rates on average, nearly 7% mortgage rates, auto loan rates, back to where they were at the highs prior, and then student loan issues. So I just feel like there's no relief coming there. Then remember, and we've talked about this a million times before, that we're now 3 years into the extend and pretend on the corporate side. Those loans have they just keep restructuring and basically diluting the borrowers each time. And based on what's happening with the consumer, you have to presume that the earnings prospects of the underlying companies aren't really improving very much. So what's the statute of limitations on the patience for that? As I said, that's what possessed me to do that 3 and 4 year moving average on the bond market, was to try to figure out, is this typical? Can we play this game forever? So who knows? One thing that I think is interesting is that Besant is a smart guy. So he's doing some things that address my concern. I don't think they're sufficient, but he is trying. You'll recognize that he has continued Yellen's program of financing the deficits with T-bills. Yep. Because I think they acknowledge that with rates where they are presently, and Trump even said that in an interview, we're going to keep borrowing short because we need to get a new Fed chairman in there who will cut rates, and then we'll be able to do more. But at the same time, they're advocating these other things like the stablecoin reserve, which would basically function as a massive money market fund to sop up T-bill issuance. So they're trying to come up with little games that will help manage us from here to there on the assumption, and it's the same assumption that the extend and pretend guys and everyone else is operating on, that long rates are going to come down. And I'm just trying to figure out how that magic happens, given the fact that, right now we're seeing long rates that refuse to bend at all. And we've seen inflation slow dramatically. We're racking up these wins around the world. And if people felt like the big, beautiful bill was going to stimulate enough growth to help us grow into the deficit, you'd think that would help alleviate some of the concerns at the long end of the bond curve. We've got credit card delinquency rates highest since the global financial crisis, and then the largest wave of corporate bankruptcy filings since that period as well. So it's not like no one's feeling the pain of higher rates. There's been a ton of pain. We also had SVB. I mean, it's so long ago now, people forget. And related to that, the banks are still sitting on almost $500 billion worth of unrealized losses on their safe treasury and agency holdings. So there has been a lot of pain. There's just been a lot of things that were able to prolong the perception that things, that we're kind of muddling through. Let's say we've been able to, on average, in the aggregate, consumers have been able to muddle through because, as you mentioned, you've got the high end that's kind of masking what's happening, all the distress at the low end. And the same is true in the corporate sphere, probably even more dramatically. You've got a huge swath of companies that just went belly up. And then you've got the Mag 7, that were all the rage and we're inflating all the averages. So we've had this environment where the top of the tip of the iceberg has captured all the attention and everyone's just like blissfully unaware that there's this massive block underneath that is really struggling. The one thing I will say about the credit markets is that risk appetite, I like to describe it as a light switch. It's not a dimmer.
It's not a dimmer,
on or off. There is no, there's a little less rabid risk appetite. It's cooling a little, it's warming a little. No, it's on or it's off. And you flip an instant. And that's what happened in 2008. And so I do think that's what we will probably see again. And then that will help everyone realize that fundamentally underneath it, the economy really wasn't that strong to begin with, and this credit bust will just kind of feed on itself on the downside. The question is, does the market rally? A lot of the reason why that helped support the upper end income is that financial assets have always been prioritized over the economy. The Federal Reserve has been the tail wagging the dog here. And I mean, what I think has happened and what drove that K-shape, I place all of the blame, and maybe this isn't fair, at the doorstep of the Federal Reserve. Basically, all they did was try to get, and Greenspan even said this after the dot-com bubble burst, and he came in and he cut rates, and he basically said, we need to reinflate assets. And that was going to be the solution, because then once you get asset prices up, then you stimulate high-end consumption, and then businesses start to pick up and hire and expand, and that helps the lower-end consumers. But the key is to get credit and asset prices moving again to kind of pump that market up. So if I'm correct that we've kind of reached the end of the efficacy of that policy, and that the Fed could cut rates in July and long rates wouldn't come down and the stock market wouldn't necessarily rally on it because long rates don't come down, that we're now moving to a paradigm where fiscal policy is primary and monetary policy really, just to the extent it's useful, is only useful to monetize the expansion of the fiscal spending. So basically, the Federal Reserve, my sense is that the Fed funds rate is far less important or impactful than the balance sheet. And that what will happen is we'll get a massive fiscal stimulus in the throes of this economic downturn, and that the Fed will re-up QE and help monetize a lot of that stimulus so as to at least hold long rates steady in an environment where rising deficits might otherwise send them higher. And therefore, the fiscal impact is not as overwhelmingly skewed to the high end. Quite the contrary. I would think the fiscal impact might be more targeted, as it was post-COVID, to average Americans. And especially under this administration, you'd think, since they've talked about it being a Main Street story, that would be their focus. But so I guess my sense is that the reason we have the K is the Federal Reserve, and that if the Federal Reserve has now reached the point where everyone knows their bag of tricks and they're not as useful anymore, that it's really going to come down to fiscal. And the way I see that ultimately being resolved is that the dollar pays the price for the sins of all this fiscal spending, to the point that we start to go the way of, let's say, Argentina, where we're printing so much money and the Federal Reserve is just monetizing like crazy, that we end up having to change the monetary regime. We can't have a fiat money regime anymore because the inflation is just too bad. So we end up either, whether it's a direct link to the dollar or a link to commodities or some hard asset basket, but that will change it. And that will be the thing that puts the pin in the bleeding and basically says, all right, we're resetting right here and we're going to start fresh. That's my sense as to where we're going. For sure, in the case of China, they're really playing the long game here. They're not worried about tariffs over the next 3 years. They are worried about, the next several decades. And so I don't see any change. And I guess to bolster my view, I would cite what's been going on with the foreign purchases of our treasuries. We had the treasury capital flows data only goes through April, and through the first 4 months of the year that captures, foreign central banks unloaded $110 billion worth of US treasuries. In these 6 weeks that we have data since, they've unloaded treasuries at a pace that is 4 times that. So they're not slowing down their sales, they're accelerating their sales. But generally speaking, they have been in no way derailed. Trump made these threats on the campaign trail. So it's probably not news to them to hear this. They weren't unaware that this could happen. And as yet, it hasn't shifted their desires to de-dollarize in any way that I can see.